Good morning, everybody. Mike Vacchi, Princetontrader.com, here with your Thursday morning market webcast. Okay, so bear market rallies, resistance to the 200-day, 50, all things we talked about yesterday, rejected down, trade as low as 26.52 quarters. So 29.47, 26.53, that's 10%. Is that the end of it? I have no idea, but it's where they bounced it from. So they bounced it back up into the 2690s. We were long last night, got stopped out. I mean, we took profits, went even stop on the rest, and there's just too much volatility. It's hard to hold things without watching them because sometimes you got to re-enter. There's just so much vol. So yesterday was another really big day in the room. It was a little choppy off the open, but once it figured itself out in and around 35 to 37, we were able to get short 36. Take that down. We took the runner on that one for 20. Then we were short 25.75. But the best setup of the day was our proprietary lower level that created a bearish bias, was retested at 27.28 half, and then the bottom fell out for the runner. It was a 64 handle runner. So when they set up like that at our levels, we can't help but have a really solid day. Let's look at the hourly chart. So we talked about 27.50 resistance. We talked about how it initially accelerated Tuesday below that, made new lows, back up to test the 50s, can't get through 50, can't get through 50, 36 becomes a problem. Here was your retest, 28.75 and then 27.5. Tested it once, gave you a second bite at the apple, and then down to that 10% correction area. Resistance at the daily pivot, kind of riding the hourly mid-band. So right now I'm flat. I really have no intention of doing anything before the open, and then we'll see how this thing wants to open up and how it wants to trade. So I got some requests with regard to the bias retest and fail trade, and there's going to be a chart out on this on the website and on social in a minute, but here's how the whole thing broke down. Okay, so here we are. It's a 5-minute chart of yesterday. So like I said, off the open, we get short 35. That was a beauty. Then it comes back up here. See, the lower level is 27.28 half. It goes ahead and establishes a bias here, takes us down into the roundy area, right down to that 27.02 that I talked about yesterday morning. 27.02 was where the bears blew it the first time around. Okay, so it comes back and it tests it, takes it right back up to our proprietary level, and gives us a really solid trade. And off you go. So bias, retest, and fail. And the remarkable thing about the levels is, especially in the volatile markets, usually it'll go down 5 or 6 handles and come back up and test that area. I can't tell you how many times over the course of many years that it has gone and done 20 handle moves down, come back up to kiss that area and go. And when it lines up with the yellow line there, which is VWAP, when it lines up with our proprietary moving average, it's just, it's fantastic. We got another bite at the apple, although, we just let what we were in continue to work. Came back up to test proprietary moving average there at 27.10, and then, another 50 handle flush. Now, through all of that, as I look at this chart, I would like to tell you that there was some panic in the tape, but I didn't feel any panic. What I did feel was a little bit of liquidation into the close, but not everybody scrambling for a fire exit. So I'll be very interested to see what the result is of this move higher, whether it can hold daily pivot and whether it can create a lower low. As we get back to the daily chart, before I let you go, I said this before and I'll say it again. This is more time than we spent below the 200-day moving averages, and that's the exponential. The simple is more like 70, 71. You're talking about sessions at a time, and you're talking about interacting it over the course of about 10 to 11 sessions in a row. I never announce character changes in the market. I don't pick tops. I don't pick bottoms. I trade my stuff. And, we take advantage of whatever the tape presents us on any given day. What I will say is for the last year and a half, I've noticed, and we've mentioned in the room, very little changes to the tape. And what I did say to my subscribers yesterday, and what I'll say to all of you now is, for years, I would say, look, we're buying dips because the dip buyers have no fear. And they're the ones that are coming in making money every day. And if you want to come in and make money every day, you have two choices. You can be short or you can make money. That's no longer the situation. These dip buyers do have fear. It was going to take a period of days, weeks, months to kind of get that muscle memory out of them, okay? And I think we're kind of getting there now. It doesn't mean there aren't going to be violent rallies. It doesn't mean we couldn't go all the way back to the highs. It doesn't mean anything. But what it does mean in the moment, what it does mean this week, what it has meant for the last 5, 6, 7, 8 sessions is that these dips are still to a certain extent being reflexively bought, but now they are being reflexively sold. And that is a nice two-sided to downward leaning market. You can see the green line here, the daily mid-band. At some point, we'll interact with the daily mid-band, either as a function of time, as the back-end numbers fall off of that moving average, or as a function of price. And when that day comes, then we'll be mapping out basically what kind of tape are we going to see in 2019. And whatever the answer to that question is, it's going to be volatile and it's going to be great. All right, take care. I'll be out with some stuff on social. Trade them well. Follow us over on Twitter, Instagram, and Snapchat at Princeton Trader. Check us out on Facebook and join us for a free trial at www.princetontrader.com. Trade them well.